Okay, so I'm going to go ahead and get started here and kind of share with you a little bit about what we're going to talk about. So everyone, I'm sure, is tired about hearing the word coronavirus. I know I am, but we're going to talk a little bit about what's happening in regards to real estate. It was coronavirus, then I was calling it COVID-19, now just COVID. Now I'm even tired of hearing myself say that, so I'm just calling it our present crisis. So we are in unprecedented times. Good news is that you can now get toilet paper without getting to most stores, at 6, 7 o'clock in the morning, where distribution channels are starting to return somewhat to normal. I like this one. You can give a thumbs up if you've seen the movie Jumanji, but it feels a little bit like that right now. Whoever started this game at the beginning of 2020, please finish it quickly so we can go back to normal life. One of the neat things I think about coronavirus is it definitely has brought people together, right? Forcing us to stay home, spend more time with our loved ones. And I think also realize that no matter where you stand financially, socially, politically, we're all impacted by this thing, to some extent or another. I like this one here. This reminds me of being at Costco with the cones, staying away from everybody. So we will make it through this. Hopefully we'll be able to have our July 4th parties, although I think that's still a big question mark. So just a little bit about me. If you don't know me, I think a lot of people here are past clients or referral partners of ours, but I've been doing real estate, a real estate broker for the last 12 years, started my career in accounting, been successful in helping buyers, sellers, and investors sell over 300 million in real estate transactions in the last 10 years. And we're one of the top 0.5% of agent teams across the county. This is my family. I've been married to my wife for the last 13 years. Those are my kids, Theo and Emma, who are 12 and 9. And I also have a 6-year-old pit bull that thinks she's a lap dog and a 9-pound Maltipoo that thinks she runs the household. So getting right to
Jordan, I think we missed a poll a couple slides ago. So let's go ahead and launch the first poll.
Yeah, go ahead.
All right.
So to what extent has your employment been affected by COVID-19?
All right, let's give you 5 more seconds to answer. Thanks, everyone. All right, everyone get their answers in. Good job.
And we got a couple more. Maybe give it 5 more. Okay, how do we do here? All right, so I'm not out of work. I've been furloughed or had my hours cut. I'm feeling some pressure, but no major changes. That's interesting. So about half of you are not feeling anything too severe. Then about another 30% have either not been affected or it's helped. Oh, that's interesting. So of 100%, there's been about 20% that have been more impacted. So that's interesting.
Thank you, guys.
Yeah, thanks for that. Okay, so we're going to go here. We're going to talk a little bit about the real estate market as it relates to Corona, some best and worst case scenario, comparing then and now. So then is the Great Recession. Most people look at current events through the lens of their experiences previous to those events. I think that's true in everything from how we parent and how we, are involved in relationships and how we look at the economy. So a lot of people that went through 2008, the Great Recession, are going to look at this and compare it to that just because it's their best comparison point. We're going to look at some different approaches for buyers and sellers, and what we should consider doing next. As I mentioned, put questions in the chat as you have them, and I'll do my best to get to those at the end of the meeting. So a great place. One thing I've been watching is a great site, by the way, just kind of side note, worldometers.info. You can kind of see the impact of this thing country by country, state by state. A lot of really good information on there. One thing that is pretty intuitive is, unemployment right now is one of probably our primary challenge that is causing us to likely go into recession. Obviously, job postings are way down. That's pretty obvious. And unemployment, I believe up to this point, the highest single week for unemployment was about 650,000 claims. But we are in the 6 to 7 million range on a weekly basis. So it's significant. We know this. But we also know that, likely it will be short-lived. A lot of these unemployment claims are related to furloughs. full-time going to part-time. And definitely there is some real, full layoff unemployment as well. But it's definitely a mixture of those three. And just a couple things, one of the big things to remember between the Great Recession and what we're facing now is the Great Recession was based on bad loans. It was based on fraud, and it really effectively crumbled, our economic system. And it was a long recovery. The housing market started getting hit towards the end of 06, definitely into 07. And we didn't start recovery of the housing market until 2013. The stock market was a bit quicker. Stock market really plummeted by 60% from when things started. Bottom was about March, April of 2009, and obviously it's been one of the longest bull market on record. Coronavirus, what people are predicting is that we're going to have a quick recovery. That we're going to see between 1 and 3/4 of recession, but it's going to look more like a V than it does like a curve. In other words, it should be a pretty sharp decline. And then, according to a lot of analysts, a pretty quick recovery, mostly because, so many of the macro trends are still really strong. And we went into this really strong. This is just such a black swan event that nobody expected. So take a deep breath and relax. There will be recovery. We're already starting to see some recovery, in other countries. Obviously, China and South Korea handled this thing one way, Italy another. Italy is kind of the extreme, where there's just been, unfortunately, a lot of chaos and a lot of death. Flattening the curve is something now that everybody has, been talking about. Give a thumbs up if you had heard that expression before this pandemic.
Very few, almost nobody.
Give a thumbs up if you've heard of flattening the curve now, after this pandemic.
Everybody,
yeah. So we know what that is, right? The downside is it's going to stretch out. It's going to take a little bit longer. But the good news, obviously, the reason we want to do this is so hospitals aren't overwhelmed and aren't able to address people that need care, and less people die. And Italy, of course, got hit, probably the hardest. So, we look at new cases now in China. Obviously, we have to take the information that comes from China with a grain of salt because of the authoritarian control over the media. But apparently their cases are down. South Korea, their cases are down. They're past their peak. Even Italy, although they're still feeling the pain, at least they're seeing a lot less, new cases happening. And the U.S., of course, looks like we're, kind of right around the peak or possibly, escaping the peak. But definitely we've seen the ramp up, and it doesn't look like it's going to be getting much worse. Of course, a lot of governors of different states are talking and connecting to figure out how are we going to start rolling people back to work, carefully and cautiously. How are we going to bring kids back to school, and what is the future of getting out of this? But there's definitely hope. So we're going to take another poll right now, Courtney, if you want to run that.
Yep. There we go.
Oh, I think we did the wrong question. That's okay.
This should be the right one.
Is it? Okay.
Yeah.
So how long do you anticipate California being shelter in place and jobs significantly impacted?
All right, I'll give you a couple more seconds. Everyone got their votes in? Awesome. Here are the results.
All right, so that's about what I would have expected. I think it's kind of, people are somewhat divided here. We got about 37% of people think about a month, 44% of people think about 2 to 3 months, 11% 3 to 6, 7% 6 to 12. Yeah, so I think that's pretty congruent with what we're hearing and what we're seeing is that, I think we're going to see a lot of forward movement into recovery in the next month, but there's probably going to be definitely some impact, especially in the hospitality industry. It may be that we are not sitting in movie theaters, for a while, or getting on cruise ships. I think it was Carnival or Royal Caribbean that put out a statement that they're not going to allow any ships to dock before August 1st. So it's interesting times. So what about housing? So housing is still strong for the moment. There's definitely a lot of chaos, fear, panic. I think a lot of that, if you watch the stock market at all, it's hard to do that and not get a stomach ache. In the course of a couple of weeks, we saw the worst day since 1987, and then the best week since the 1930s. So it's been a lot of volatility. So day traders are excited; they're making tons of money on volatility and buying and selling. For those of us, that have 401ks and whatnot, it's a little bit scary, right? We watched it plunge from 30,000 down to 18,000, and now it seems like we're hovering right around 22, 23. But remember, the stock market is very liquid, right? Things can move fast. The same is not true with housing. It's not the same with housing. I remember even thinking back to the Great Recession when home prices started dropping in 2007. They didn't find bottom, and with a little bit of ups and downs in the meantime of volatility, but it didn't find bottom until 2012. So it was a slow fade. It took about 5 years for housing to give up. In Orange County, about 30 to 35%. Of course, Inland Empire got hit a lot harder, right? There were neighborhoods during the Great Recession that dropped by 60, 70%. Orange County, not so much. Orange County has, one of the nice things about Orange County real estate is that we have a constraint. We have two main constraints on supply. So what I mean by, constraints on supply, things that would prevent, further building, right? One of those is mountains, right, to our east, and the other is on the west. It's the ocean, right? As they say, God's not making any more ocean. So because of that, we've always got that natural constraint on supply. So what's happening with bonds? 10-year Treasury is still historically low. It was kind of bouncing up and down, but really it's been below 1% for a while now. This is what mortgages are tied to, right? Is the 10-year Treasury. So interest rates are still very good, and we anticipate them staying low. We're seeing two challenges right now in the mortgage market that are unique. One of those was the refi boom. There were so many people refinancing because rates were so low that lenders were absolutely at capacity. So there were actually some lenders, even as far back as a month and a half ago, that were actually slightly raising their rates to slow down the demand for those refinances, because they were having capacity issues. Another issue we're seeing right now, partly because of Corona, partly because some other more complicated factors that we're not going to get into today because it's a 3-webinar series just to talk about that piece, but is the liquidity in the mortgage market. So the secondary market right now, that market that actually buys those mortgages, makes those mortgage originators whole, so they get their money back and they can make another loan. There's limited liquidity in that secondary market right now, which is making it more difficult for lenders to do loans. So that's why we're seeing literally interest rates fluctuating about a point. I'm seeing rates anywhere around 3.5 all the way up to 4.5. Depending on the day, depending on the time of day, because of those capacity issues. So we do anticipate that to get better. It's just going to be a question, of when. But right now, the 15-year sits around 2.75, and the 30-year just under 3.5. Again, though, that's the rates you may see online. You may hear your friends talk about those rates. Actually getting those rates, depending on the lender you're dealing with, depending on the liquidity issues, is not always actually what you're seeing. So it's a weird time in the mortgage market, but for the most part, you're somewhere between 3.4 and 4%. So getting into California, how's California dealing with Corona? The good news is that our state has the 5th largest share of workers with access to paid sick leave. We have one of the largest rainy day funds, and we are among some of the best states that are prepared for digitalization. So what does that mean? A lot of people telecommute. We're a very tech-savvy state, so we're seeing us weather this storm, quite a bit better than a lot of other states. Real estate, it was an interesting time. So right around the time when I remember it was a Wednesday evening, I saw a notice where, California, Orange County, went shelter in place. And then Thursday morning, it was kind of reversed. It was almost like they were stepping on their tongue. And then later that day or early the next, they went back and said, oh no, we are going to do a shelter in place. And it was about a 1.5 week period where we were told in real estate that we can't go out there. We can't meet with people. We can't do inspections, appraisals. We were shut down. Thankfully, that lasted all of about a 1.5 weeks. And on March 28th, real estate was declared an essential service. So what that means is we're able to, we still can't do open houses, we can't be in large gatherings, but we are able to meet with clients, list homes, show properties, of course, respecting social distancing. Some of CAR's guidelines are, of course, they want everything as much as possible to be done electronically. They're encouraging more and more virtual tours, showing homes, of course, only by appointment with limited number of people in the home. And inspections and appraisals can now take place. Of course, social distancing must still be practiced. And a lot of our clients are definitely, being very careful, right? Wearing masks, gloves, booties, that kind of thing, to just be as cautious as possible. So NAR, the National Association of Realtors, did a really good study. They took a poll, of 6,000 real estate agents across the country and put together those findings. So what they found is that a majority of home buyers and sellers are bypassing the spring housing season. So this is where normally Q2 is really the busiest quarter for real estate historically. It's looking very much like that may be shifted into Q3. Another thing that they found is 59% of agents said buyers are delaying home purchases, and 57% said sellers are delaying listing their homes. So you'll notice those two things are pretty much going hand in hand. 90% of agents said there will be a drop, or there is a drop, in interest among home buyers. So there's just less home buyers out there looking for homes right now. 80% of agents found a lower number of homes on the market. 63% of agents said that buyers are expecting a drop in home prices. And yet 72% of agents said sellers are not reducing those prices. So it sounds like at this point, those 62% of buyers is wishful thinking, but only time will tell. Redfin did a unique study as well. They said that right now, a third of home tour requests last week were for agent-led video chat tours. That's up from about 1% around the first week of March. So again, something that really wasn't something that people did. People have adapted and are starting to do more of that. And then 12% of offers written were from virtual showings, up from around 0% the first week of March. That means there are actually buyers out there that are making offers on homes without actually seeing them in person. So that's pretty unique. You see that sometimes with investors. You see that definitely in lower price point markets across the US. You don't generally see that, in Orange County. So what we're seeing right now is somewhat of a showdown between supply and demand. Of course, supply is not booming, right? There is, of course, that's the fear of when we look at the Great Recession. It was a supply issue. There's just too many homes on the market because people couldn't afford their homes. Well, today, we're not seeing that. People have equity. People are not necessarily putting their homes on the market. In fact, they're pulling them off the market. But of course, we are seeing demand pull back as well. So this is Orange County housing inventory. This is number of homes on the market in Orange County. So you'll see here in 2019, we started the market with almost 6,000 homes on the market. We started 2020 under 4,000 homes on the market. So we started with a really, really limited inventory. We had the same supply problem in 2020 at the beginning of this year that we've had, back in when the real estate started booming again, like in 2013 through 15. So we started with a really low inventory. And of course, as you see, we are continuing along this just kind of flat line here, where typically in the spring, we would increase in inventory. People are bringing their homes to market. We usually see inventory peak sometime around July, early August, and then it starts to fall again. So we're just seeing not enough homes on the market. How does that compare to last year? We're 39% lower right now at this time of year than we were last year. So there's one problem is just, the amount of homes coming to market. The other problem is this hold problem. So over 800 sellers pulled their homes off of active status into hold status, which is an off-market status where they're saying, hey, I still want to sell, but I'm hitting the pause button right now and our home is currently not available. So a good chunk of inventory is now in hold status. I imagine those will start to come back to market. And then of course, demand. This is extremely unique. I have to imagine if you pulled the last 20 years of Orange County housing demand, year over year, you wouldn't see something like this. So demand is measured by the last 30 days of pending sales. So the last, 30 days, how many homes went into escrow? And again, typically we would see demand, peaking kind of late spring, early summer. And yet, of course, we saw it just fall off a cliff. So we are literally 34% lower than we were 2 weeks ago. and compared to last year at the same time, we're down 35%. So how is that affecting expected market time? So expected market time is the average number of days it takes a home to go into escrow from the day it hits the multiple listing service and is fully marketed to the day that a contract is received and escrow is opened. So if we look at last year, average days on market at this time of year was 76 days. Sorry, I lost my train of thought there. Today we're at 105 days. Last year we were at 76 days. And just a couple of weeks ago, we were at 79 days. So just a dramatic, change there in the average days on market. So they consider a seller's market is anything under an average of 90 days on the market. A balanced market is about that 90 to 120 days. So we are definitely heading into a buyer's market. I'll say two caveats here. One is this is for all of Southern California. So this is not just Orange County. This is also across all price points. So if we were to break this down by price point, I'm not going to go that granular right now, but you would actually see that up to about $1 million, Orange County is still doing okay. We're actually still in that 70 to 80 days, average days on market. When you get up over $1 million, you start to see it soften. You get over 2 million, it starts to get a lot softer. But that $700 to $1 million kind of mid-level / entry-level Orange County single-family home is still doing okay. We do expect this to continue to climb until all those buyers get off the fence and back into the market once we're 30, 60 days out. I'll tell you, if I get 10 showings on a listing, 7 to 8 out of 10 of them are saying the same thing. Great home, fits my needs, it could be a candidate. I want to see what happens here in the next 1 to 2 months. So a lot of people are just hitting the pause button. So what are some best and worst case scenarios? The best case is that jobs are back and people go back to work. Most people are saying that, this will be an exponential graph, not a linear graph. If people are off work, the longer that people are off work, it will get exponentially worse. In other words, if we're back to work in 30 to 45 days, most people can weather that storm. If it turns into 60, 90, 120, that's where it obviously can get uglier and uglier. We know, Dave Ramsey tells us we should have a 3-month emergency fund. A lot of people don't have it right in the US, especially in Southern California. A lot of people live paycheck to paycheck. So that's where it can get ugly. This unemployment problem can really exacerbate. Again, it looks like we're getting to, I don't want to say in the clear, because I think we'll be feeling the consequences of this for a while, but it looks highly likely that we're starting to roll people back to work, in May, early June. So another best case, inventory stays low. If you're a buyer, that's not your best case, but it would be the best case for the market as far as stability, and holding the line on prices, or at least staying in balanced market territory. Rates will stay low. I don't anticipate or see anything that would indicate rates are going to be anything but low in the foreseeable future. It is very possible that once liquidity returns to the market and mortgage lenders figure that piece out, that in the next 1 to 4 months, the 30-year could very well be at 3%. I mean, it could be the lowest interest rates that we've ever seen on record. Again, there's no crystal ball, but based on what the 10-year is doing, based on going into recession and a number of other factors, it's definitely possible. So we could end the year, again, some analysts are saying 2020 will end okay, and 2021 should be a strong year for housing. What's the worst case scenario? Work doesn't resume. This continues into that 2 and 3 and 4 month period. Unemployment continues to increase, which eventually leads people to, not be able to pay their bills, including mortgages. Tenants stop paying rent. Landlords can't pay their mortgages either. Some industries collapse. Again, more job loss, hyperinflation. It's probably an outlier. My bet would be 60% of best case, 5 to 10% worst case, 30, 35%, somewhere in the middle, where we continue to feel the effects, but it's better sooner than later. So we're gonna have you take another poll right now.
There we go.
What do you think the impact on the housing market will be? These are some longer responses, so we'll give you guys a little bit more time here to get more answers. Some of you just don't like multiple choice questions.
All right, I think we've got them all. We'll end that and share the results.
Wow, so that was pretty strong. So about 76% of you say that there will be some impact. Housing may go into a balanced market, slow some, and remain relatively flat for the next 12 or so months. About 21% of you said that there will be a significant impact and housing values will be negatively affected. And then a small portion of you said, just one of you actually, that there will be a great impact. Nobody thought there would be no impact. And I think we're already starting to see that as our days on market start to increase, that there's going to be, some impact on housing, but I would say I'm number two as well, but there will be some impact that will go into a balanced market, that it won't be the multiple offer kind of place where we were, where things were just flying off the shelf in a weekend and sellers are calling and saying, it's been 10 days, why isn't my house sold yet? That could shift a little bit. So I'm going to talk a little bit about the differences between now and our last downturn as it relates to housing. It's definitely apples and oranges. Like I said, it was a long time of that subprime ramp up, right, of giving people loans. My favorite is the ninja loan: no income, no job, no assets. Here's your loan. Thank you very much. That's not today. I thought this was a neat infographic. It just kind of lets you know that in previous recessions, housing prices have actually increased in 3 of the previous 5 recessions. And if you see the 2 recessions where housing was greatly impacted, and these are national numbers, were led by housing and financing. So those recessions, the cause of them was financing and housing, which is why, of course, housing was impacted. 2008 was the subprime meltdown. 1991 was the savings and loan crisis. So just keep in mind, it's not necessarily a direct correlation between what's happening in the stock market and what's happening with housing. Another thing is that unemployment and home sales do not have a direct relationship. Is there some relationship? Yes, there is a correlation. I'd say a moderate correlation. And yet, on the same token, there have been times when unemployment is relatively high and we're still seeing a decent volume of home sales. There's another one. This shows you what the unemployment rates were at various years during the Great Depression and the Great Recession. This is the biggest concern right now, is this unemployment factor. But again, a lot of the experts are saying people are going to get back to work. Yes, there will be jobs that don't return for a while, and there will be some jobs that don't ever return, right? In some small businesses, mom and pop kind of operations, and definitely the tourism industry is getting hit really hard. These are Goldman Sachs projections. They're anticipating it to level off very quickly and for unemployment to return, to pre-corona levels. Another interesting chart is the Credit Availability Index. So this is put out by the Mortgage Bankers Association, and they look at how easy is it to get a loan. And there's a number of different variables that go into this metric. But at a high level, it just shows you that, they were giving away money way too easily, right? When we had the previous bubble. And today it's still relatively difficult to get financing. When we were seeing multiple offers, which was very recently, right, until things really got hit by this crisis, I'd see a situation where I had 8 offers, 10 offers on a property, and only 2 of those maybe were VA 0% down, FHA 3.5% to 5% down. I would say 70% of the offers that I receive are anywhere from 15 to 40 or 50% down. So people are putting real skin in the game. And lenders are still looking for the 3 main criteria, right? They're looking at your assets, right? Your collateral, they're looking at your credit, and they're looking at your income. There are some lenders where if you have 2 of the 3, in other words, if you have great credit, great assets, but you write off all your income so you don't have to pay Uncle Sam. There are bank statement programs. There are some limited doc programs, but even those programs are make sense lending. In other words, you qualify for a loan. It's just very apparent that for tax purposes, you're writing off all your income. Same thing, if you have great assets and great income, but not great credit, there are some programs for you, but you're going to pay a much higher rate, and you're going to be required to have a lot of skin in the game, maybe 40, 30, 40, 50% down instead of 10 or 15 or 20. So in other words, people out there aren't making the poor decisions that were being made, in 2004 through 2007. Appreciation is another thing to consider. The 6 years leading up to the housing crash, the Great Depreciation, the Great Recession, we saw just a lot of exuberance, really, really fast appreciation. Yes, we are still seeing appreciation, and again, these are national numbers, but it's not to the extent that we were seeing it back then. Inventory is another one. We are still seeing a pretty limited inventory of homes nationwide. In 2007, right around the time of the crash, over 8 months of inventory. Months of inventory of homes is the number of months that it would take to sell all existing homes given current demand if no new homes were to come on the market. So in fact, there's areas in Orange County where still in that entry-level home and condo prices, you're still seeing 1-2 months of inventory, very, very limited inventory. Now, again, a lot of buyers are on the fence. So there's two prongs, right? There's supply and demand. We are having a demand issue. I'm not going to deny that, but I would anticipate that that demand does come back into the market in the next 1, 2, 3, 6 months, right? In the foreseeable future. Affordability is another one. So again, this is definitely a nationwide number, because here in Orange County, we put these numbers to shame. I mean, we can dwarf these. We can spend 50%, right, of our income on our home on a monthly basis. But nationally, in 2006, people were spending about a quarter of their income, right, on their housing expense. Today, it's about 15%. Now, how can that be? It can be because, one, interest rates are much lower. And even though home prices are, at where they were, and even in some cases higher than they were in 2006, do you realize that 2006 was 14 years ago? So think about it. Homes are barely higher than they were then, and yet incomes have risen, right? Even if you just take 2-3% over a 14-year period, incomes have come up. So between the lower interest rates and the higher incomes that people are earning, people are spending less on their housing. Leverage is another really interesting one, right? We have the 3 years leading up to 2008, right, when Lehman Brothers went under. People cashed out $824 billion out of their homes. So they were stealing from the register, treating their homes like a piggy bank. And today, in the last 3 years, people cashed out about a quarter of that. So get this, right? You have better interest rates, more equity, more expensive homes, and yet about a quarter of the cash out that was happening then. This is still a big number, don't get me wrong, but it pales in comparison into what happened, prior to 2008. So I'm going to talk to you about a few different approaches. How do you put this into practice, and how does this impact you, if you're a buyer, if you're a seller? I would say, so I'm going to start with talking to investors. If you're a real estate investor, make sure you have reserves. I think some real estate investors think they're investors and they're actually speculators. In other words, they're betting on appreciation and hoping that home prices will keep on track to just go, go, go. A real investor is looking for cash flow. So make sure you have reserves if you're an investor, and that you're looking at properties, making sure that they are positive cash flow. Be careful with development. I think if you're looking to go into a project that's, in and out in 2 or 3 years, these are uncharted times. And so I would just be cautious with those longer deals. And if you are getting into a deal right now, I'd say you want to have some kind of deeper margin. So you want to be getting into deals that have definitely more meat on the bone. And you also want to anticipate that it may take you longer to sell that home. So keep in mind, don't look at it today, look at it, maybe not what a worst case scenario would be, but, hope for the best, but do plan, for a poorer case scenario than we are, right today, just in case. Long term. So now I'm going to talk to home buyers, whether you are looking, to get into your first home or upgrade home, or if you're in a home now, cash in on these low interest rates. So if you're in a home already, kind of see what happens here in the next 1 to 3 months, but definitely consider refinancing. And if you're looking to buy, recognize that interest rates are smoking and rates are high. And what's interesting, rents are high. And what is interesting about rents is that they're not greatly impacted by a recession. When we look at the Great Recession, it was a little bit of softness with rents, but for the most part, those rents kept up. And even obviously over the coming years, they continued to go up, because when people were losing their homes, guess what? Those people still have to live somewhere, right? So that's putting actually upward pressure on rents. So what does that mean? It means that home ownership still makes sense, regardless, what the short-term market is doing. You have to live somewhere. That being said, you ought to have a 5 to 7 year horizon. If you're thinking about buying and getting in and out in 1 to 3 years, you ought to rent. But if you have that 5-year horizon, that could make sense, to buy. How about sellers? What should sellers think about doing? Most people, if you're thinking I might be a home seller, it's because usually you have to move. I mean, there are some people, right, that are just looking to upgrade because they want more space. And yet a large portion of people that are selling is because they need to sell. Either it's, people die, people get divorced, people relocate for work, people need to go from 2 stories to 1 story. There's all kinds of reasons that people move. And I would say that sellers should still sell. And here's why. If things recover quickly, then being ahead a month or two should not really affect you very much. When we look at average days on market, I have a number of clients right now that we've been supposed to go on the market, this week or next week. And we're just kind of hitting the pause button. We anticipate maybe going on the market in 3 or 4 weeks instead of right now when people are kind of more released out back into the public. And if you think things are going to get worse, then it's definitely a good time to sell because you want to get out of the market. So I would say that if you're looking to transition and make a move, like I said, I would get everything ready now. Perhaps wait a couple weeks, for buyers to get back out there. But I wouldn't necessarily say, oh gosh, everything's, the world's falling apart. I'm not going to move now. I don't think that that's really warranted. So what should you do next? So I'm going to give you just some kind of high level ideas. We're not going to get super nitty gritty and tactical. But one big thing is I play the long game. Don't get distracted. Be very careful with your news consumption and your social media consumption, because there's so much negativity and so much noise and so much distraction that it can just completely get you off course. I had an interesting conversation with, my financial planner a couple of weeks ago when the market lost 20-25% in a very short period. I was freaking out a little bit. And he said, Jordan, how old are you? And I said, I'm going to be 36 this year. He said, and are you going to retire anytime soon? I said, no. So don't even look at it. Just relax, play the long game, stay the course. And I think that's really good advice. I'd say pay off debt. Again, I think I would be conservative with maybe riskier investments right now. I'd encourage us all to explore, what debt we have in our life that can be like an anchor that can drown you in difficult times like this. And if it's too late, where the debt's already hitting you and starting to drown you because we're here now, let that impact you and help you to make decisions to get yourself in a better place for the next black swan event, because they always happen. In fact, the same thing, I had a conversation with my financial planner about 2.5 years ago. Can this bull market go forever? What's going to happen? He said, I don't know. We don't know what is going to throw a market. We could have never anticipated a terrorist would crash a plane right into the Twin Towers. We could have never anticipated coronavirus, right? We can't anticipate everything. Have an emergency fund, right? Prepare for the worst, hope for the best, but be cautious and make sure that you are able to weather a storm like this. And hopefully this is a storm that passes sooner than later, right? And it's a 30 to 60 day event and not a 3 to 6 month event, because I think that's where, again, it can get dicey if it lasts that long. And then I think get ready to find opportunities. So I had someone say to me recently, don't waste a good recession. And I said, well, what do you mean? And he said, there's 3 or 4 opportunities in most people's lives where everything goes on sale, right? And you have an opportunity to double down the dollar cost average and to make some really good decisions that can have a really great impact on your future, both with the stock market and with real estate, right? So I think being in a position to kind of put a plan together now, to be ready when those opportunities present themselves, because they absolutely will. And finally, just, a quick plug for us, whether you work with us or whether you worked with us in the past or you work with somebody else, find a real estate team that's got experience, that's got a team approach that can provide a concierge level of service, that's really able to market effectively, that is professional, that has a track record, that has, online credibility, and is really going to do the best job for you possible. Courtney's on the call with us today. So thank you for being here with us. Courtney's a graphic designer and BA in visual communications, and she's just been a great part of our team. Most of you that have worked with us have met Michelle. She does transaction coordinator is the understatement of the world, because she's like my right arm when it comes to just making sure that both our buyers and sellers, it's just a seamless process from start to finish. And this is our team of fantastic agents that just love to serve our clients. And just a couple things that we do that maybe not everybody's aware of. I think most of you know that we help people buy, sell, and invest in real estate. We also help people with their property management needs. So you just auto collect your rent each month and not have to deal with any of the stuff that makes most people not even want to own real estate, because it can be such a pain in the butt. And we can also help with 1031 exchanges for those investors that own appreciated property and want to make sure that they're deferring that gain and not paying the man the big bucks. And we've added some other services to our listing services, again, just to make everything as seamless as possible for our clients and to put the very most money in their pockets as possible. So if you have specific questions, maybe that are beyond the scope of kind of some of the more general things we've been talking about here, I would definitely love to consult with you. There's no cost, there's no obligation, there's no pressure. If you're thinking about buying, selling, getting into your first investment, definitely love to have a virtual meeting with you. We can do like a 15-minute phone call or a 30-minute Zoom video just like this. And I'm happy to answer any questions you have, just be a resource to you, whether it's now, next month, next year. And now I'd love to get to some Q&A here before we wrap up. So I've been hearing, I talked to a lot of different lenders out there in the market. I heard some lenders have literally shut down their VA and FHA financing right now, as there is some concern. Again, they're playing it safe. If values do drop, you think about a lender that's doing an FHA loan with 3.5% down. Theoretically, that buyer, if they had to sell 3 months from now, they're already underwater, right? After paying, real estate commissions, title escrow, and closing costs, there's no equity there. So that lender is already underwater. And so lenders are playing it a bit safer right now. Like I said, some lenders are shutting down FHA and VA. I just got an email from another lender I work with saying a number of his lenders have shut down jumbo financing. Got an email today from Chase that they're still doing jumbo loans, but people are being a lot more cautious. So the lending is changing fast, and there's some, again, it's a whole nother webinar in itself, but there's some challenges with this forbearance where lenders are saying, sure, we'll give you forbearance. If a mortgagee is not paying their mortgage for a couple months, that's creating a tremendous amount of pressure and financial impact on the servicer of those loans. And if you can't get servicers to service loans, the whole industry shuts down. So what the government needs to figure out, and I'm sure they're in process of working through, is how do we make this work so that if we tell the borrowers we'll forgive them and work with them, how do we work up the chain and make sure that all levels in that food chain are also getting some kind of relief so that they can continue to do, what they do. Yeah, inflation is a good thing for hard assets. And if we see inflation, which I don't anticipate although they are printing a lot of money and they're doing a lot of quantitative easing, if we saw inflation, it's correct. It is a good thing for hard assets. So gold and real estate, right? Real estate is made of commodities. So it could be a good thing, absolutely, for real estate. So back when things were really bad, right, in 2012, and the market came back in full force, 2013, right, we saw like 25% price increase in Orange County, and then it started to level off 10%, 8%, 6%. It's been up, but not to the same extent. Early on in that cycle of recovery, all the smart money, we call it, investor money, we call it smart money, the people that have billions and make their smart decisions, they were buying like crazy. So we were seeing there, I think 2014, 15, 16, over 30% of purchases were all cash. That's nationwide. Today it's more like 18, it's been hovering around like 18 to 20, which is kind of about normal. So we're definitely seeing less cash buyers now. I think, again, the smart money is always a little bit cautious when you get this deep into a bull market. I don't think so. Again, I mean, I'm not really biased. I mean, I own real estate. Obviously, I help people, buy and sell real estate. So it's not good for me. I wouldn't want to see that, but I don't really anticipate it. Namely, again, because people have real skin in the game. Always think back to economics 101. It all comes down to supply and demand, right? If supply stays the same and demand plummets, that's going to have a negative impact on pricing. If supply and demand move down together, there shouldn't be a whole lot of impact on pricing. And if supply and demand move up together, there shouldn't be. It's when it's uneven, right? If supply is high, demand is low, that's when things get ugly. I think right now people still have a lot of equity. I think a lot of, the market, especially in California, I think we'll recover from this thing pretty quickly. I think we'll see 1 or 2 difficult quarters. I would anticipate the next several years we won't see the same kind of growth that we've seen. I think it'll be definitely muted and much more conservative. But I'm not seeing an immediate event. And I always think this too, that if housing does start to slow down, right, and we start to see less movement and even possibly some negative pressure on pricing, that's when you see those non-QM lenders come back into the space and start getting more aggressive with their financing. They start doing more limited doc. They start making it easier to get financing. If you see that stuff start coming back to the market, then it's a matter of time, right? Because if lending gets too aggressive, we repeat the mistakes of our past, and that's when it could get ugly. But again, I don't anticipate that in the near future. I think it's still a great market to be a flipper. If you can get in and out of properties in 3 to 6 months, real estate just doesn't move that quickly pricing wise because it is so illiquid. And I think too, one of the things that holds real estate prices stable is stubborn sellers. In other words, something may be happening in the real estate market. It literally is going to take about 6 to 9 months for what's actually happening to make the news and for consumers really to feel it. So in other words, for a seller to say, okay, I'm okay with selling my home for less than the most recent comparable that wasn't as nice as mine, it's like, good luck, right? We all know how stubborn people are. So unless there's a position where people have to sell, that to me, could put that downward pressure on prices. But as long as people don't have to sell and there's not a flood of inventory, I anticipate us being relatively stable.